All right, folks, let's go ahead and get officially started for our webcast, The Power of Covered Calls. Thank you again for taking the time to be here. I look forward to the next hour or so. I think there's going to be some great information that we can share with you. And thank you all once again for taking the time. Let's go ahead and jump right into it because there's a lot of good information that I want to share with you today. Again, in today's webinar that's titled The Power of Covered Calls. I want to start by just amplifying the idea that the covered call trade is really the most basic. It's the simplest, most popular option income strategy available to you. Okay, it is a commonly used strategy. I know we were talking before we got officially started. A lot of folks already trade covered calls. Many of you don't. But hopefully after today's session, you will want to, because one of the reasons it's so popular is that when done correctly, okay, you can achieve some very good results, like our successful subscriber, Jerry. We did a case study. One of our was very had a great chat with Jerry talking about his success, and these are his words. He went from a hit or miss with no methodology process that he was using to consistent monthly income. And over the last year or so, he was able to get through 44 trades, 70% wins, and he broke it down to a monthly income of 2% per month. And I'll also use his words here. I'll speak for Jerry, but when we were talking, he said the 70% would have been higher except for some of the rules he chose to stretch a little bit and not really follow. And so that 70% might have been even higher. But he broke it down to a monthly income of 2%. Now, I want you to understand what that might mean for those who are looking for a way to generate a safe, steady income. Compare it to a good quality dividend stock. Okay, if you have a good quality stock that's paying, I don't know, 2, 3, 3.5, 4, even 4% dividend annually. Okay, an annual dividend. So think of padding that source of income with the monthly, or I'm sorry, a weekly covered call trade that will give you somewhere around 2%, sometimes a little higher every month. That's the average for a time frame, and that uh, can be very significant again when done correctly. So we'll talk about that more as we go through. So if learning how to do that sounds good to you, now is a great time to turn off all distractions. Okay, close your door, turn off your cell phone, or at least put it on vibrate. Close other windows that might be open on your computer. Okay, I don't want you to multitask because I don't want you to miss anything that's important here. Stay focused, give this your full attention, because I truly believe that learning about this can make a huge positive impact on your retirement. So, as I always do, I promise I will give you everything I can during this hour, and at the end, I will show you where to go to get more help, because we want you to be able to get results fast. With that, let me go. Oh, my screen's shaking up a little bit. Let me go ahead and officially introduce myself. I see a lot of familiar names, but some that I'm not familiar with in the chat box. My name is Jim Penna. I'm the manager of retirement services here at VectorVest. I've been here for going on 15 years now, and it's been great. I moved my family down a long time ago to North Carolina because I got tired of shoveling snow, and I was able to find VectorVest way back when, and so it's been a great run here at VectorVest. Just to give you some background, I took my Series 7 back in, I think, 92, 93, I think it was 92. Became an assistant trader on some small desks and ended up as a market maker on a larger trading desk in New York, and until I decided to move down south. Let me just give you one more piece of information. In 2 prior lives ago, I uh, I was a police officer in Norwalk, Connecticut, and so at any point during the webcast, if it sounds like I'm telling you to do something, just know that's where it comes from. And as I always say, it's hard to do humor in a webcast because you can't always get when that comes through. Anyway, again, that's my background, just so you know who's talking to. More importantly, I am part of a bigger team here, our education team here at VectorVest. Some great friends and colleagues that I work with Miss Linda Royer, Mr. Don Payton, leading the team. These are all my teammates here in education. So we do our best. We've been around for about 30 years now. We're dedicated to helping you achieve a secure retirement. And then finally, before we jump in, I've become inclined to use this slide. I ran across this slide putting a presentation together, and it just sticks with me now. And I think it's a great place to start because, um, some people look at success and they think this is what it looks like, right? To the very few and the very lucky, it may sometimes look like this. But it's important to remember that for most of us, this is really what our path to success looks like. There is work to be done. There are mistakes to be made and things to learn from. And whatever the topic is, I just thought this slide caught my eye, and that's why I share it with you today. Keep that in mind as we go through. All right, let's jump into why we're here today. This is a quote from a gentleman named Lee Lowell, and he wrote a book called Get Rich with Options. He was a option trader in the pits up in New York, long time veteran of that, and he wrote a great book called Get Rich with Options that our founder, Dr. DeLito, had read and recommended to us, and it's got several trades, income trades, but one of them is the covered call. And I found this definition that he wrote down the most logical, the most straightforward definition, especially for those who may not be familiar with covered calls. And I highlighted it here. First, he started, if you own shares of stock and you're not selling call options against them, you're throwing away free money. And then here's his definition. There are traders out there who will give you money today for the right to take your stock away from you if it reaches a higher price. Okay, that's the exact definition of a covered call. Pay me today to take my stock away at a higher price so I can make even more money. He goes on to say, selling covered calls is such a great strategy for padding your bank account. I still can't believe there are investors who are not taking advantage of it. And quite frankly, neither can I. And that's why we're here today. Now, for those who may be new to options, I'm going to take just a few minutes to talk about what an option is. Okay, for some of you, it may just be a quick review. Okay, but stay with me because it's the foundation of what we're going to do here. You're going to hear me say several times throughout this presentation when I describe an option contract. It is just that. It's a contract with strictly defined terms and conditions. Okay, it's also a security. An option is a security. It trades just like a stock, meaning that there's a bid price and an ask price, and a market maker who is tasked with providing a fair and orderly market. Okay, so keep that in mind. It's a contract, strictly defined terms and conditions. Okay, we like to think about it as an actual physical piece of paper, even though it's not something you actually hold in your hand. But it is an agreement between two people to buy or sell a stock. The owner of the option has the right to either buy or sell a stock depending which option he owns or she owns. Okay, so what we like to do is think of it this way. We'll break it down this way. So you have your option buyer and you have your option seller. Okay, the option buyer pays money to the option seller. And in exchange, the option seller writes a contract and gives it to the option buyer. Now that's why it's an option seller is also referred to as an option writer. Okay, so you'll hear me use both terms. Selling an option or writing a contract are synonymous. Right? If I'm the seller, I write the contract or I sell the contract. They mean the same thing. So the option buyer has paid for the right to buy or sell a stock depending which option he bought. Right? He now owns the contract giving him those rights. And on the other side, the option seller gets paid. Right? But an option seller never gets paid for nothing, right? He takes on obligations to fulfill the other side of the trade if the option buyer decides to exercise his or her rights. Okay. Let's start here. There are two types of options, and only two types. There are call options and there are put options. So any of those other fancy sounding trades, iron condors, butterflies, straddles, etc., they're all made up of either buying or selling a call and or buying or selling a put. So let's understand these two core trades as we go on. A call option gives the owner of that call the right to buy. In other words, if you buy a call option, you're paying for the right to buy a stock at a certain price by a certain date. Those are the strictly defined terms and conditions that we'll talk about in a moment. Okay, so if you're the buyer, you have the right to buy a stock at a certain price by a certain date. Also, let me just say that where the name call option comes, right? You have the right to call away the stock from the option seller, right? That's where call option, right? I can call away that stock or buy it at that lower price. Now, for a put option, you have the right to sell a stock. So if you buy a put, you're paying for the right to sell a stock at a certain price by a certain date. Or to go with the name of the option is to put that stock to someone else, right? I'm going to put that stock to someone else. Hence the name call and put. In this introduction, we're going to focus on call options. So let's specifically look at what's going on with a call option. Again, the buyer, we know, pays money to the option seller. The option buyer just bought a call option and he now has the right to buy the stock. The option seller has received cash, which is also called the premium, and he now has the obligation to sell or provide that stock to the buyer. Okay, so the buyer of a call has the right to buy, the seller of the call is obligated to sell. Okay, everybody good so far? Okay. There are a few additional things that get worked out on this contract, right? More terms and conditions that we have to focus on. So when we talk about those terms and conditions, here is what the buyer and seller agree on. They have to agree on how many shares would be exchanged. Right? How many shares do I have the right to buy in this case of a call option? At what price will the stock be bought or sold, depending on the option? When will the option expire? Because remember, options have an expiration date. The seller doesn't want to be locked into this agreement forever, and so at some point, the contract will expire. And then finally, how much will the option cost? In other words, the premium. The buyer will pay the seller for these rights. So as a seller, if I'm going to take on an obligation, I better get paid for it. And so he accepts that payment for a certain duration of time. Okay, so that's just a quick introduction to the terms and conditions of an option contract. And so let's go ahead and break down each one. A lot of folks will see this in an option chain or read this, and you see it traded this way. And you may see it listed this way. This is the way an order is kind of set up. All right. For those who are new, might say, well, what does all that mean, right? One Apple June 130 call at $2.30. What I'm going to do is take a minute or two and break it down piece by piece. Okay. So again, we're talking about a call option. All right. So that one is the amount, the number of contracts, and of course the underlying equity. Right? Remembering that an option is a derivative of the underlying stock. So this is one contract for Apple. Okay. So if we look at it from the buyer's point of view, I have the right to buy 100 shares of Apple. That's what this contract conveys. And if the buyer exercises his right, the seller will be obligated to provide that 100 shares to the buyer. Okay. They also need to work out the price. Remember, we said the price is part of the terms and conditions. So the buyer says, I have the right to buy 100 shares of Apple at $130 per share. Okay, that's the price at which we strike the deal. And so if the buyer exercises that right, the seller is obligated to provide those shares at $130. Once they agree on the price, they now have to agree on the expiration date. Okay, they have to agree on the expiration date. Now, the expiration date is the last day to trade the option, also the last day, business day, that you can exercise your right as the buyer. Typically, the options will expire on the third Friday of every month. Now, there are a lot of stocks now that offer weekly options, but we're going to focus on the monthly expirations. Okay, so the buyer again knows that his rights expire on the third Friday of the month, where the seller knows that his obligations end on the also the third Friday of the month. Now, when we look at June and we look at the monthly options, again, it's going to be the third Friday of the month. So in this case, if using today, if you were to see this at your broker, it would the expiration date would be June 18th of 2021. That would be the third Friday in June. Okay. Okay. Next is the premium, right? So we talked about one Apple June 130 call option contract at $2.30. That's the premium. Right? How much the buyer is willing to pay for these rights. In this example, the buyer said, I'll pay $2.30 per share, or $230 for this one contract. Right? And the seller says, yeah, that's right. You're going to pay me that money for me to take on these obligations. So that's the breakdown of an option trade. So some of the key terms of options, I want to do just a quick review, and we're going to get into the covered call once we have this foundation. Remember that the buyer has the right to buy a stock at a certain price, strike price, on or before a certain date, or the expiration date. Remember that the seller is obligated to sell a stock at a certain price by a certain date if the buyer chooses to exercise that right. This is important because we're going to talk about selling call options. Right? We're going to take on obligations when we sell a call option. We talked about contracts. Again, quick review. Remember, each option contract controls 100 shares of stock. Right? It controls 100 shares. One contract, if I own a call option, gives me the right to buy 100 shares. And so that 100 is the multiplier. If I did 10 contracts, well, then I'd have the right to buy 1,000 shares. And if it were 3 contracts, 300 shares. 5 contracts, 500 shares. Okay, so remember, one contract equals 100 shares of stock. Next, we talked about the expiration date, and we said it's on the date on which the buyer of the option ceases to have rights. Okay, the option expires, and the contract goes away. Let's talk more about the expiration date. Most option expiration dates, again, are the third Friday of the month. I understand there are weekly options. There's even some ETFs and indexes that will expire on different days. But for our purposes, we're going to focus on that monthly expiration, which is the third Friday of the month. But always remember this: you pick the expiration date when you initiate the trade, whether you're a buyer or a seller. Okay, it doesn't change once you've entered the trade. So let's look at it for a moment from the seller's point of view. So if I'm looking at, again, I'm looking at Nvidia, and don't worry about the time frame or whatever, and I'm looking at it, there are expiration dates for April, then there's the May expiration and the June expiration. Okay, so the seller's thinking the more time that I give, the more unexpected things can happen. So I need to charge more if I'm selling the longer term option. Right? It's going to cost more for the buyer because there's more time there, and the seller wants more premium for that time. And naturally enough, it's called time premium, or part of it's called time premium. So expiration dates that are closer to the trade date and they have a lower premium. Expiration dates that are farther away have a higher premium. So the further out in expiration, the higher the premium goes. Put basically, less time equals less premium. More time equals more premium. Also keep in mind when we talk about time to expiration that the value of an option depreciates more and more as the expiration date gets closer. It's called the time decay. The Greek for it is called theta. So what we have here is just a theoretical example of an option 180 days to expiration at 70 cents. What you need to understand is that it takes 135 days to lose 50% of the value of that option. All other things being equal, just assuming theoretically that the stock stays where it is. Time decay will eat away 50% of that after 135 days. But you can see what happens here. It only takes 45 days to lose the next 50% to time decay. Okay, the value drops off there. That's an important factor that we'll talk about in a bit. Okay. All right. So remember, the expiration date, the date on which the buyer of the option ceases to have rights, less time, less premium, more time, more premium. The closer you get to expiration, the more time value will eat away at the value of that option. Now that's not always a bad thing, and we'll talk about that. For an option seller, it's actually a good thing. All right, let's quickly talk about the strike price. The price at which the buyer and the seller agree to exchange the stock if the buyer decides to exercise his option. Right? The buyer has rights conveyed by the contract. If they decide to exercise that right, the strike price becomes important, and we'll take a look at that. Whether you buy or sell an option, remember you pick your strike price. That is where your rights or obligations will kick in. For example, we'll look at a call option. Let's say a stock is currently trading, in this case, I believe it's NVIDIA, and it was trading at 97.53 at this time. Okay. Strike prices above the stock's price have a lower value. Anything above the strike price has a lower value because there's no intrinsic value to them. Okay. So at expiration, if a stock is at $97 and you had an option giving you the right to buy it at 110, right? It's not worth anything. Right? When it's trading in the open market at 97.5 and you have the right to buy it at 110. Right? The buyer's point of view says, why in the world would I go out and exercise my right to buy the stock at a higher price at 110 when I can buy it in the open market at 97.50? So that option would expire worthless. Okay, that's why strike prices above the stock's price are called out of the money. Okay, stock's trading at 97.53. I own the right to buy it at 105. It's an out of the money strike. Premiums get lower and lower the more out of the money the option is, right? Because of probability, the chances of it going up there are slimmer. So you get what you pay for, in other words. So it's all about the odds and probability. So again, premiums get lower and lower the more the option is out of the money. We flip that logic. Strike prices below the stock's price do have intrinsic value because they're worth something to whoever owns them. Okay. They have the right to buy a stock at a lower price than it's currently trading for. So if I had the right to go out and buy ABC stock at $80 or $85 when it's trading at $97, there would be what's called an intrinsic value to that option. I could exercise my right and buy the stock at a lower price. It means the option's worth something. And just to do some quick math, if I own the right to buy the stock at 90 and it's trading at 97.53, my intrinsic value would be $7.53. That would be the intrinsic value. But it's worth something is the key takeaway there. So again, premiums get higher and higher the more in the money the option is, and they get lower and lower the more out of the money the option is. And here's one more visual on that. You'll see the premiums for NVIDIA here. It shows the premiums for two different strike prices. Okay, and those premiums for the two separate months and the different directions for the price. So notice how the premiums for the same strike prices increase as you go out a month. So if you were looking, say, at the 105, it's cost $241 for the shorter time frame, But if you were to buy it 65 days out, you would pay more money for it. And the same thing as a seller. If you were to sell 65 days out, you get paid more. And you can also see the deeper in the money, the more expensive or the higher the premium goes. Right? So if I want to take a risk and say I think Nvidia is going to go all the way up to 125 and it's only going to cost me 26 cents a share to take that risk, well, there's a reason it's only 26 cents a share, and that's, like I said, you get what you pay for. The odds or probabilities are going to be very, is it possible it can go? Of course, but the probabilities are against you. Okay, so we talked about the key terms. We broke down piece by piece the trade for an options trade, and we focused on call options. So what I want to do now is take the next step and take us into how a covered call actually works. Right, we're going to take a look at it from both the buyer's perspective and the seller's perspective. Okay, it's important to have that foundation of how the covered call works. So that's what we're going to focus on now. So how does it work? Well, first of all, like any trade before you hit the enter button, you have to know your objective. Why am I hitting the enter button to place this trade? Very, very important factor in any investment or trading. Our objective here is to generate income. Right? It's a safe, steady way to generate income, as Lee Lowell put it, to pad your bank account. So what we do is every week we look for a covered call candidate as a way to generate income in our retirement portfolio. So the steps we're going to take, our plan here is to first to look at the difference between selling a covered call versus selling an uncovered call, which is otherwise referred to as a naked call. We're then going to look specifically at the covered call, talk about how it works, and we'll do a walkthrough. And we'll look at the common trade objectives, and then we'll finish up there. So let's start with covered versus uncovered call. What is the difference there? And it's very, very important to understand this. Okay, so there's two possible scenarios when you sell a call. It can be considered a covered call or again, a naked call. So again, we're focused on the call option, and remember this from earlier. The buyer has the right to buy the stock. The seller is obligated to provide or sell that stock at a certain price by a certain date. Okay, let's first consider the naked call. Again, naked means as the seller of the call option that you don't own the underlying shares of the stock. So you don't own them to fulfill your obligations to sell. Right? Meaning you would have to go out into the open market to provide those shares. Okay, you don't own those shares. As the option buyer, saying, listen, I have the right to buy that stock. But the seller says if the time comes and that buyer exercises their right, I'll need to go out into the open market to buy the shares so I can give them to the buyer at that agreed upon price or the strike price. Now, the buyer of the option, he doesn't know and doesn't care if you own the shares or not. It doesn't affect the option buyer at all. Okay, so this is the naked call. This is the risk that the seller takes in a naked call. The other scenario, of course, is the covered call. So the covered call means that you already own or you simultaneously purchase enough shares to fulfill your obligations for selling the call. So now you still have the option buyer saying, hey, I have the right to buy the stock. Remember, he doesn't care if you own them or not. And as the seller, if you do already own the shares, you're thinking that if the time comes, I'll just supply the stock that I already own. It doesn't cost me anything. In fact, I'll probably make a little more money. Right? You can call away the stock that I already own. Okay. So that's the scenario there. Let's take a look at it on that, how that plays out on a graph for an actual stock. This is Freeport McMoRan. This is a recent trade that was done. in our Tuesday coaching session. FCX is trading at this time at $38.69 per share. $38.69. We went out and sold a call option on Freeport McMoran with a strike price of $40 per share and an expiration date of June 18th, and we took in $2.26 per share. Okay, I sold someone else the right to take my stock away at $40 per share when I bought it at $38.69. And they paid me $2.26 to do that. Okay. So what does it actually mean when you do that? Let's break down what that actually means. Since one call option controls 100 shares, at $2.26 per share, they paid me $226. If FCX is over 40 at expiration, I would be required to sell or provide 100 shares of that stock at $40 per share. Okay. At expiration, they would call away my shares. Now, if I didn't own 100 shares of FCX, you'd have to go out and buy them at the current market price and then sell them at 40. So what if the stock shot up to 47.50? I'd have to go out and buy it in the open market and provide it to the buyer of the option. Right? There's unlimited risk when you don't own the underlying shares. Okay, that is called a naked call, and we do not recommend selling naked calls for anybody who's new to this. Right? It's an advanced option trade where you have to be very cognizant of the position and stay on top of that, because otherwise your risk is unlimited. Okay, so important point to understand, and where a lot of the power of the covered call comes from, because you don't have to worry about that. Because if you do own the 100 shares, you'd simply sell your shares at the strike price of $40. So you're actually making capital appreciation as well. Let's illustrate what that looks like. So this is a covered call. Right? I already own the shares. I sold you the right to take them away at $40, and you paid me for that right. Now, what happens if FCX is below 40 on expiration? Well, first of all, I would not be obligated to sell my shares, right? So I would still own the shares at expiration because it's below the strike price, right? I would also get to keep the $226. That's mine, right? That's my money, plus whatever profit, or it might be a small loss, that you have on the 100 shares. Or it might be a bigger loss, because the risk is inherent here in the fact that we own the stock. That's one of the beauties of the covered call. If I own it at $38.69, if it closed at $39.69, I would keep my $226 plus the $100 of capital appreciation from the underlying stock. Right? And that's how I get paid. So let's do a quick recap of the two scenarios. We'll start with the covered call. And all that means is that I am long the stock and simultaneously short a call option. Right? I sold a call, short meaning that I sold it. You already own the stock prior to selling the call, or you buy the stock at the same time, which is called a buy right. Buy the stock and write the contract simultaneously. That's the covered call. Uncovered simply means you tried to short a call and didn't own the underlying stock. It's called a naked call. We don't recommend it. The fact is, you need the highest level of approval in your options trading account. And if you don't have that, here's what happens when you try to sell a naked call. Like smoke will come out of the back of your computer screen. It'll start sparking and stuff. It'll kind of blow up your system. So just be sure you don't accidentally, if your computer doesn't do that you accidentally sell a naked call, because it's a very risky position. Okay, special note on what we're talking about here. The trade, our buy right trade, will involve buying a stock and selling a call at the same time. Okay, the strategy for income. Now listen, there are great strategies to sell against stocks you already own, but we're going to focus on the steps and the idea of doing what's called the buy right. So buying the stock and selling the call simultaneously. Understanding you can sell calls against any stock you already own at any time. All right, let's look at a quick profit and loss chart here. This chart shows the profit and loss of just trading a stock. Okay, not an option. Down below is the stock price on the x-axis. The y-axis has the profit and loss. We know that when a stock rises in price, so too does our profit. Right? Stock rises, so does the value of our position. Theoretically, as the stock falls, losses occur. Theoretically, you can go to zero, and that's our max loss. Okay, so if you're long a stock or if you buy a stock, that's what the risk reward profile looks like. Okay, now let's look at a covered call. It's very different. The first thing to notice is that this is an overall bullish trade. Okay, we're buying a stock, which just inherent in that fact means that it's a bullish trade. If the value of the stock rises, so too does the value of our position. Okay. So what happens here, however, is that you have to understand that the profit is capped on the covered call. Okay, because the strike price is right here. Remember, this is the price at which you agreed to sell your stock or provide your stock. So even though you own the stock and the price goes way up, you wouldn't see any of the benefit because you'd have to sell the stock at this price. So your max profit is capped. Okay, so that the difference between the stock price and the strike price is the capital appreciation plus the premium you take in. One of the great things about covered calls is that it lowers your cost basis. Right, so your break even is a bit lower. So at expiration, the break even is whatever you paid for the stock minus the premium that you received. Right, so it lowers your cost basis. That's one of the benefits of a covered call. So the stock could stay where it is or actually move down a little bit, and you can still make money on your covered call position. And then, of course, as I said, you own the stock, and so the max risk theoretically is that the stock can go to zero. But of course, we would have management techniques in place. All right. So that's the setup on a covered call. The very important numbers to know: our max profit, our break even, and the max risk. Let's take those numbers and apply it to our FCX position so I can plug in some numbers on that. So the max profit here was the capital appreciation we determined is $40 minus the $38.69 that we paid for the stock. That's $1.31 in capital appreciation. Okay, again, this is the max profit if the stock is above 40 at expiration. Remember, we took in $2.26 of premium. So the max profit on that is $1.31 plus the $2.26. That's $3.57 or $357 per contract. Okay. Which I don't have the percentage, but that's about, I don't know what it is, 6 or 7%, somewhere in that range, somewhere between 5 and 7% return in just 30 days. That's the max profit. Now, the break even we said was the stock price minus the premium that we received. So our actual cost basis or break even, those two terms are synonymous, break even and cost basis, is down at 36.43. Right? Remember, we paid 38.69 for the stock. It could fall to 36.44 and we wouldn't lose any money, or even 43. But of course, losses can occur if the stock continues to fall. But we've built a cushion and we've lowered our cost basis. And again, our risk management techniques would have us using exit strategies and have those in place. Okay, so that's just filling in some of those numbers for the risk reward profile. Always keeping in mind, again, our objectives. Now, some of the benefits are that we get a lower cost basis. It's a great way to partially hedge a long position. Remember, I said you can sell covered calls against stocks you already own. Where the market is now is a good time to sell stocks, lower your cost basis and what's going on in the market. But what I'm talking about here right now is a steady system to generate a safe income week over week and month over month. Okay, so that is our goal ultimately of the covered call trade. Okay. I had a conversation with our founder and mentor, Dr. Bartolito, a long time ago when we first began the retirement services division here. And I went to him, and after being on the road, when we used to go on the road and do our seminars and the money shows and all the things we used to do, whether it was on the phone or emails, I told him, hey, Dr. D, the question that comes back in some form or fashion always to us to me was, how do I keep from running out of money in retirement? Right? In some form or fashion, that's what I was usually asked. And so I asked Dr. D, what do you think? And in only the way Dr. D can, he kind of looked at me and he said, well, James, just tell him to keep making more money. Just keep making more money. That was his very straightforward answer on how do you keep from running out of money in retirement. And this is a great way to do it. It's a safe way and a steady way to do it. And as I talked about earlier, when done correctly, as our subscriber and friend Jerry said, he went from a hit or miss. He had no method to it. Had a couple of winners here and there, but really wasn't generating any income. And then he began to follow our process, and his monthly income began to grow. And again, 2% monthly income, sometimes a little higher, maybe a little lower, depending on what the market's doing. And as I said at the beginning, in Jerry's words, he said that that percentage would have been even higher had he stuck with the rules on a couple of trades as he was just starting out. Okay, so the important part is understanding and being able to do this correctly. Okay. And so I know some of the folks in the room here are familiar with our retirement coaching group. We do once a week what some of you may remember as the Payday Portfolio. As long as the market is cooperating, unless we're not in some dramatic down day, once a week we go out and we do the buy rate for what we call the retirement income portfolio, what we used to call the Payday Portfolio. And so last year in our Payday Portfolio, we had 25% return on investment. That includes not the dividends, the premium we received, as well as any capital appreciation, as I showed you in the Fcx trade. Okay, we had 38 trades that were executed. Okay, which came out to 76% winning trades and a 25% annualized rate of return. And that was a great year. Is every year going to be 25%? It may not be. But I'll ask you guys to ask yourself, if you went out, followed a process that was successful, and you were able to generate in an account with the objective of generating income 13 or 15 or 18% by doing one trade a week, you'd feel pretty good about that, I think. Okay, 76% winners. Anyone here who thinks there's a system out there that will net you 100% winners? I say this to our students and subscribers all the time. Somebody tells you there's a system that gives you 100% winners, what should you do? Right? I say walk away because they're not telling you the truth. Yeah, Carrie says run. Yeah, exactly. So how to get started creating your own payday portfolio. Here's what I feel is the best way for you to start doing this so that you can create this payday portfolio. Again, we do a trade not every single week, but pretty close, again, depending on what the market does. So here's a great way for you to get started. It is called, we're starting a 7-day, what we call the Covered Calls Boot Camp. In just 7 days, you'll be fully trained to place your very first covered call trade. And if it's not your first covered call trade, hopefully it will be the first covered call trade where you actually applied a very straightforward, common sense system to placing the trade. So having a way to generate income is a must if you want to be on the road to that worry-free, peace of mind retirement. As I said in the beginning, the covered call is one of the safest, most popular, most powerful income generating strategies available, and it should be in the arsenal of every investor and retiree. Our training sessions will guide you step by step from the beginning to the end. We'll start with the basics of options. Okay, we talked a little bit about it today. What is an option? We'll talk about what a covered call is and how it works. Okay, we'll go into deeper detail. I'll make sure, even if you're new or you're scared of options, that that you'll be successful. You don't need, to be an advanced option trader to sell covered calls. Okay, you just don't. You just need to know the system. Okay, and once we get through that, we'll talk about the very important factors of when to trade. As I said, it's a bullish trade. You have to recognize the proper time. We'll talk about what to trade. Right? Remember, an option is a derivative. There's several steps. First, you find the quality underlying stock, and then you walk through the setup. Right? We have to make sure that that quality underlying stock is also favorable as the option candidate. They're not always. And so you need to know exactly what to look for to set up your trade. And then where a lot of folks, regardless of what type of trading it is, whether it's just options or stocks, whatever it is, okay, managing the trade is extremely important. I'll show you exact rules for managing the covered call trade. Right? We'll talk about when to trade, what to trade, how to set it up, and then probably most important, how to manage it once we're in. Where to get out for our proper profit levels and where to cut our losses. And then finally, we'll actually show you how to enter your order with your broker. I'll teach you this live, and you'll have access to all the training videos in case you miss a live session or want to review the videos multiple times. It'll be in our university, VectorVest University. And as I said before, generating income is critical to retire with peace of mind. So the live bootcamp training sessions will start on Tuesday, May 25th. Okay, you will be ready to place your first covered call by June the 2nd. You will be armed with everything you need to confidently place that trade. You don't have to be, a market genius or an options expert to find a good quality stock and generate a good steady income for doing it. Now, you can get a head start. The university will have all of the training videos available immediately upon joining the bootcamp, or as we like to say, enlisting. Right? You'll get the head start. All the training videos will be there, and you can start going through them today. So to join the bootcamp, while we're live on this webinar, the price has dropped down to $395. The regular price for this course is $795. Because you've taken the time to be here today, we're going to save $400 for you. If you go to VectorVest.com/CC Bootcamp. Okay. The $395 price. Now, Brian and John and I are going to stay on and answer any and all questions, so you have some time to go to that link and sign up and take advantage of that $395 price. Okay, the registration for the course itself, for the bootcamp, will close for good on Monday afternoon. So if you're ready to begin placing covered calls, join us in the bootcamp by going to VectorVest.com/CC Bootcamp. Okay, and we have put the link in the chat box where you can just go ahead and click on that link. And remember, the $395 rate is only while we're live on this webinar, so take advantage of it while you can. Again, we're going to stay on. There's a lot of folks in the room. We're going to stay on and answer any and all questions. We believe so much in this course that you'll successfully complete the bootcamp that we're going to offer you 100% money back guarantee. I often say that there is no risk-free trade in the markets, right? Hit the enter button, you're taking risk. However, this would be a risk-free trade for you. Right? If you go through the bootcamp, show that you've done the work and you're still not satisfied, we will gladly give you a refund. So it's completely no risk for you. So, listen, we're also counting on the fact that you not be one of the very few people out there who go through the bootcamp, learn an amazing income system, and then still ask for a refund at the end. Right? It's not fair to us, not fair to you either. We want you to join the boot camp if you're serious and excited to get started. Okay, we hope that you fall into line, as they say, for boot camp. We'll enlist you in the boot camp. Okay. So again, go to VectorVest.com, CC Bootcamp, join today, take advantage of the special price. Remember, after this webinar is over, it'll go back. It'll actually go to $495 and then $795 after Monday. So once you join or enlist, as we say, go ahead and type in the chat box that you're in. I'd love to welcome you by name, tell you what to look for, and I'm excited. I hope you are too. So um, go ahead and type in if you've gone to the site. We want to make sure the site's working. We want to say that thank you for being in and tell you what to expect. Okay, and with that, as you're typing in there and checking out that link, I'm going to ask Brian to come in and help me answer some of the questions that are coming in. John and Brian did a great job, but we're going to answer any and all questions. So, hi, Brian.
Hey, Jim. Can you hear me all right?
I can.
All right, beautiful. So there's a lot of excitement. John and I were kept very busy with questions and comments and about covered calls in general. So you generated a lot of excitement. So we had the people who are, by the way, folks, the link is in the chat, just like Jim mentioned, vectorvest.com/ccbootcamp. You could also type that into a browser and take advantage of that price. If you're a VectorVest member, this price, the $395, is lower than elite pricing by a couple of dollars. So elite pricing is $397.50. So we tried to make this price so that way you didn't have to worry about any kind of elite pricing or anything. You just knew that this price of $395 is lower than what you could get anywhere else. So if you just click on that link, you can get in. And like Jim said, all the training is available right now. And you can go through it immediately, and that way you're ready for the live sessions that Jim does. So those of you who are in, we're sending you a welcome. We're sending you an email right away with all the directions. You can start going through it right now. So speaking of that, Jim, you work very hard on recording all of the sessions. So you recorded them, but you're also teaching it live, right?
Yes, that's correct. All of our live sessions that we're going to have for that week of May 25th will be live, so we can answer live Q&A questions. But all of those resources are also going to be in the VectorVest University, for which anybody who signs up will have access to those for one full year, by the way. So all of the material is recorded and archived with other resources, broker help videos, and other things like cheat sheets and spreadsheets that we use to journal our trades. All of that will be available to everyone.
Cool. So we actually the first live session is actually next week, right? It's what is it? Tuesday.
Yeah, Tuesday. Yeah, yeah. We're going to start on Tuesday, and we'll begin our live trading sessions. Yeah, I believe they're 4:30 Eastern time, if I'm not mistaken. And we jump right in, and it's a 1 week boot camp. We're going to get you ready to start generating that payday portfolio, that safe, steady income, um, to get you going.
Yeah, and there's some questions in the chat. I'm just going to try and bunching a bunch of them together here. If there's a bunch of people here who are brand new to VectorVest, so if you're brand new to VectorVest, we'll give you access to the VectorVest tool to help you out. It really helps you find stocks. I mean, you could do the covered calls on good stocks you know about, but Jim will teach you in the boot camp what to look for exactly. So if you choose not to use the VectorVest tool, which hopefully you don't make that decision, but if you choose not to use the VectorVest tool, you at least know what to look for in a stock to do your covered call on. All right, so he'll show you exactly what to do, what to look for, what to find, how to set it up. But the question is, do you get access to VectorVest if you don't already have it? Yes, we'll give you 30 days of access to it, to the VectorVest tool. All right. So again, go to vectorvest.com/ccbootcamp. This is a quick turnaround, folks. The registration is going to close Monday, Monday afternoon. So that is only a few days away from today. So you get in there while you can, because we are starting this up with live sessions on Tuesday. And so Jim will teach it live. What is it, Jim? Like 4 or 5 days with live training, and and then you're actually going to be showing people the trade that you do, because you do a trade every Tuesday. So I think we have it planned that on Wednesday you're going to talk to everybody about that trade and any trade that they've placed, right?
That's right. So just to bring back the train, it starts on Tuesday, and we're going to go through all of our steps. And as Brian mentioned, on Tuesdays in our coaching group, we do our weekly trade. So after our training sessions are done on that Wednesday, we're talk about that trade, your first trade in the after going through the boot camp. So that's what the schedule is going to look like. And as Brian said, yeah, quick turnaround. We're going to get right to it on Tuesday, um, and then walk right through. So we'll have a training session. How many are there? There's five. So because Memorial Day is the 31st, we'll do it on June 1st, and then we'll do our trade.
All right. And then what we'll do is, if you place a trade which is different than the one Jim did, we'll of course talk to you about it if you have questions about it, or if you just want Jim to hold your hand. He can't tell you, we're not financial advisors. We can't say, yes, go place that trade, but we could take a look at what you type into the chat and see if it meets the rules. And then on the 3rd and the 4th, Jim's going to still be there with you with Q&As. So there's a whole bunch of live sessions. And if you miss anything, everything is recorded. It's actually, the training is available to you right now. And you could be like Stan, who just typed into the chat box. He's like, I can't wait. You put an exclamation point at the end of it. So, and it's brand new.
Yeah. Yeah, and that's a key point, Brian, that you just made. I see a couple of things coming through the chat box. So if you can't make the live session, please understand we will record that, and it will be in the university, VectorVest University, later that evening. So you're not going to miss anything if you can't make a day, one of the days or two of the days. All of this information will be recorded and archived. So keep that in mind.
All right. Now, Jim, if you can go back, there was a slide that had a link on it. We'll just remind people it's vectorvest.com/CC Bootcamp. And as Jim shows there, it is a 100% money back guarantee. So you'll know within like a week, right, whether it's right for you. Like, you should know now. You kind of have a feeling in your gut that it's right for you. But within a week, we're going to be you're going to be trained. It is like, how long is boot camp usually? Like 6 weeks or so. So you're going to be done in a week, and you're going to be ready to go to place these covered calls. So Jim, there was a couple of questions about the size of the account. Can you kind of maybe talk to people about? You had mentioned $40,000
Hmm.
is a good size to be doing the covered calls. I saw somebody said that they have 10,000. Another person said they have more in their retirement account. So why did you kind of settle on? Why do you advise to have the 40? Is that a magic number, or what's the deal?
Yeah, no, there's a reason behind that. We talk about 40,000 to 50,000 as a number, and what you'll learn in the boot camp is when we talk about position sizing. But let me just give you a review of why we do that. The way our process for selling covered calls works is that we're not fully invested right out of the gate. We're doing one trade per week, again, as a payday. Okay, so as long as I'm averaging my positions the way, a kind of a conventional way that we do it, at $10,000 per position. So what we say is I can go out and buy 100 shares of a $100 stock and sell a covered call against it. Right? I could buy 200 shares of a $50 stock and sell two covered calls against it. Okay, if I do one trade like that per week, right? I don't need 400,000 or $1 million to do this, because I'm never going to, well, rarely will I be fully invested. So the following week, if the market is cooperating, we do another trade. We're only going out somewhere, but our guideline is somewhere between 30 to 45 days. We stretch it out a little to 60 days. But as each week goes by, we're doing these trades. So we're never going to have 8 or 9 or 10 trades open at one time. These trades have expiration dates, and they have management techniques that will have us out of the trade. So really, only $40,000 or $50,000 is enough to certainly prosper doing this trade. And so that's where that number comes from. Now, um, you know, You can do it with lower price stocks. We put a price tag of $100 on the stock. You can lower that. You can raise it if your account is larger. Okay, but that's the number we come up with. Again, following the techniques that we'll teach. Your position sizing is very important, and the way you manage them is very important. So that's how we go through. That's where that number comes from.
And I see some comments also from people who have taken other training here at VectorVest. Like Jim said, we've been around for 30 years, right? So here at VectorVest, over the years, we've taught, and in fact, Jim teaches another course here at VectorVest called the Options Jump Starter, which is more for people who are looking to buy options. If you're looking to buy calls, buy puts, it's a profit system. This is more of an income system, what Jim's talking about here. So Jim does teach a profit system with options, and it is more designed at people who are new to options to get them up to speed on calls and puts and buying calls and buying puts. This is brand new, totally different. It is 100% focused on covered calls. There's a section at the beginning which we call like an indoctrination, where Jim will spend about 40 minutes. He put together a little training for people who, kind of like today's session, which is just teaching you what options are. But then the rest is all dedicated to covered calls, finding them, setting them up, knowing when to trade, what to trade, kind of what Jim showed in that slide with the big blue arrow. He shows you covered calls straight through. So it is totally different than the Options Jump Starter, than the Options Paycheck, if you are familiar with either of those courses. The only thing, if you've taken our Ultimate Retirement Solution course, there was a part of that course which Jim taught covered calls in. Right? This, we just boiled it all down, and it is 100% focused on covered calls.
Right, and just to add to that, I see Glenn's comment in there. The options jump starter, as Brian just described, is the beginner's guide to buying calls and buying puts. We did talk about in a bonus session covered calls, but the boot camp goes, as Brian just commented on, that it is strictly designed for covered calls. We go much deeper into the process and the trade management in the boot camp than we do in the bonus session for options jump starter. So we go a bit deeper there.
Yep. And I think if you go back a slide or so, there it'll show the price again, just in case people were asking. There it is, the vectorvest.com/cc bootcamp. That $395, as Jim mentioned, is good while we're live. So we got about 10 minutes or so left while in this live session, depending on the questions that come in. And then actually the price will go to $495 right after we're done. So you can save $100 by getting in now, and then it'll go to $495 when we're done, and then registration will close on Monday afternoon.
Yeah, Brian, I'd just like to say, that's we had 70%, 76% winning trades. That's about the average of what we make on one successful trade is the 395. I mean, you'll make you make the money in the course on one or two covered calls will easily cover the price of this course. So keep that in mind.
Yeah, I was just listening to our interview to Jerry again. Remember, you had highlighted Jerry during today's webinar, and one of the questions we had asked Jerry was, like, how long did it take you to get in there and start actually doing covered calls after you learned about them? And he said right away. Like, he learned it and was immediately in there doing the covered calls. So that's why that's one of the reasons why we're super confident that after this 7-day boot camp, you're going to be in there placing the covered calls. This is the most popular trade that brokers and retirement accounts have you doing, because you're typically buying stocks anyway, right? So you're just adding a covered call. It doesn't, right, Jim? It doesn't add any more risk.
It adds absolutely no risk. In fact, lowers your risk because it lowers your cost basis and your capital outlay. And I like to say, I mentioned earlier, I took my Series 7 in 1992. At that time, the only option trade you could do in an IRA account was a covered call back then. Why? Because it added absolutely no risk to a position you were already in, and in fact lowers the risk. Now, most of the mainstream brokers, you can do a lot of different option trades, but just confirming the idea that right, selling the covered call just limits risk, lowers your cost basis. And I go back to that first slide and the way Lilo in that slide said it. When you look at it, the way he phrased it, right? Somebody's going to pay you money today that goes into your pocket. It's your money, by the way. As soon as you hit the button, they're going to pay you today to take your stock away at a higher price. Okay, it's a trade that again, if you're building and managing your retirement portfolio, your future, your net worth, there's no stronger, easier trade than the covered call.
All right. And by the way, folks, I put the phone number to our office. Yes, we are real people. We have real people answering the phone. So if you go to if you're for some reason if you're having any kind of trouble with the order, or if you just have questions that we might have missed, you can call that phone number and someone can help you out. 888-658-7638. It works. It's our North American number. If you're overseas, just if you go to our website, we have toll-free numbers across the world. All right. All right. So we had some more people saying, "Ah, man, the first one I noticed here is Chuck." So welcome to Chuck. We're excited about the boot camp. What I'm going to do, folks, is since so many questions they've actually scrolled off my screen, I can't see them anymore. So if you could, I'm going to put a little flag on my screen here. All right. So if you have a question about this boot camp and you're kind of like on the fence, or you're trying to figure out if it's for you, and you need Jim to answer a question, even if you've typed it in before, can you just highlight it and copy and paste it back into the chat? Because it went off my screen and I can't see them anymore. So we'll do our best to answer these. Like I said, we've got about 10 minutes or so. So the first one I see here, Chet says, I'm sorry, I had to take a phone call while you were answering the questions. He says, on how much of your portfolio you needed for covered calls. Check about how much was that number? Thanks for portfolio.
Yeah, Chet, what we said was I used the number 40,000. The process that we use, one trade a week, dollar weighting or averaging, I should say, about 10,000 per position. Somewhere around 40 to 50,000 will get you started and can generate very nice percentage gains for you.
All right, and I can answer this one. Somebody had wanted to know it. Is it required? Two people asked it different ways. One person says, do they need to buy extra software and extra plugins to do this? And another person said, does VectorVest provide tools to help? So two people with kind of the same question, just asked different ways. Number one, Jim's going to teach you how to do covered calls, whether you use the VectorVest tool or not. And he's going to show you exactly when to be placing them, exactly what stocks to do them on, what characteristics, what to look for, and how to set up the trade. Does VectorVest, there's a base VectorVest product called VectorVest 7. Does it help you find those stocks? Definitely. Yeah, there's some searches in there that Jim runs and makes it very simple to find a small basket of stocks to look at, and then it saves a lot of time when setting up the trade. If you're saying, do I have to buy any extra plugins? Nope. Some people are asking about Options Pro or whatever. Yeah, there's tools in there that can help you even further, but do you have to buy those things? Nope. So you could, if you wanted to, the base VectorVest software is great to help you out, and it provides tools in there to really streamline the process. In fact, Jerry, that Jim mentioned in today's session, said that's what he does to kind of speed things up. So I don't know, Jim, if you wanted to add anything to that. I don't want to say you jumped in there, but go ahead. If you have anything you want to add, go ahead.
Yeah, no, that's you hit it all right on the button. I was looking to see if there were other questions I could help with, but no, you covered it. Perfect.
All right, so let's see. Rangan says, "Can I do this in an IRA account?"
Yes, the vast majority of the mainstream brokers, I don't want to say every single broker and catch myself there, but the vast majority of any broker will allow you to sell covered calls in your IRA account. I'd be very surprised to hear one that doesn't. There may be some. The vast majority will allow it.
Next up is David over from Belgium. He says, I'm afraid of short expiration periods are not going to give enough premium that will outweigh the high purchase cost of the shares. He says, better not to do this, or does the training stay valid for longer expiration periods?
Yeah, that's a great question. There's always there's a lot of ways to do it. A lot of systems that'll say sell the weekly, sell the very short term, which I am just do not advocate doing. There are many studies out there for people who think that they can go out and sell. There's two different ways to look at it. You can go out and sell much shorter term options, call options on your covered calls, and think that you're going to generate more because you're doing more trades. Then there are the folks who think, well, I'm going to sell like 6 months out or 9 months out because, as we talked about in today's presentation, the premium's going to be higher, so I'll make more money. I can't even, the countless studies say that neither of those are true, right? The industry standard for I'll call it a sweet spot, is going to be somewhere between, I'll say 30 to 60 days, generally 30 to 45. I stretch it out to 60 because it's okay to go a little bit longer, but not any longer than that. So to your concern about the time frame, I've been selling covered calls and studying these and going through these. This window that I just talked about is going to be the most profitable. Um, and we have strict rules or guidelines that we use for the amount of premium that we'll settle for, okay, and the overall return on the investment from the position. So I don't recommend going out and selling 9 month calls out because you think you're getting a higher premium. Okay, it doesn't work that way.
All right, so next one is, we can both answer this one from Bill. He says, uh, does this include the weekly coaching group with trade selection? Bill, the answer, the boot camp doesn't. Remember, the boot camp's 1 week. All right, so we're going to be in and done. But it starts, like first off, you have access to all the training right now once you join. But the first live session is the 25th. And then by 1 week after that, you'll be placing trades. So it doesn't include Jim's weekly coaching that he does. So we'll give you the option at the end of the boot camp if you want to continue with Jim. And because Jim finds these trades, you'll look every Tuesday. Of course, if the market's going down, right, Jim, you're not going to be doing these trades.
Right.
But Jim's going to does this every single week. So if you want Jim, look over his shoulder and look at those trades, you could choose to do that, or you could do it on your own, and you could be just as successful as people like Jerry.
Yep.
I didn't want to. If you want to, again, if you want to add anything to that.
No, it's listen, it's all about this. It's all about the system, and that's the techniques in the system that's going to get you profitable.
And that's actually one of the things that Jerry highlighted when we talked to him, right, Jim? He's like the process, the systems, the rules.
That's
All the systems,
that's right. Those
over and over and over again.
right. Those were his words. The hit or miss with no methodology is when he was not being successful.
All right, Steven says, what time is the class? So we tried to make it easy, right, Jim? All of the classes are 4:30, if I remember.
Yep, 4:30 Eastern time, right through the week, starting on the 25th, and going right through that following uh, Wednesday. Keeping in mind May 31st is Memorial Day, but yeah, 4:30. And also keep in mind, if you can't make one of them, the live session will be recorded and placed into the VectorVest University resource page for the boot camp.
Yep. So we had a question from Chet. He's familiar with spreads, and we also teach spreads in another course called the Options Tape Deck. But he just wanted to compare and contrast a little bit. He says, are covered call options generally safer and or more profitable than doing spread options?
Yeah, that's a great question. A lot of folks will compare the two. The truth is that they both have the same objective in mind, right? They're both income trades, and in many ways they're similar. Now, here's the difference, and I'll let you decide which is safer or more profitable. The profitable part will come on how many contracts you use or how many shares you buy. That's going to be up to you. As far as safer goes, here's the difference to me. If you're in a call spread or a credit spread of any kind, that expiration date is the end of is the end of your trade, right? So it does take a little more time to manage. You have to be on top of that. But with a covered call, here's what can happen. I don't want to get too far into this, but if the stock stays flat or even moves down a little bit, I do have the option, excuse the pun, of holding onto the stock and simply continuing to sell covered calls, excuse me, against that position. So that's the difference. So it's hard to say what's more profitable. It depends on how much time you put in the credit spreads. But as far as safer goes, I think that's you're still trading on the derivative on the underlying stock. I like the covered calls because there's no expiration on when I have to sell my stock. So that's the difference. What's safer and more profitable? That's a little tougher answer, but I like the covered calls because I'm a little more in charge.
And people could do. Some people choose to do both.
Hey, you can definitely do both of them. There's no doubt about that. Again, in your retirement account, how you allocate. Somebody mentioned much earlier on. I happened to see it. How much do you allocate to a growth portfolio, to a dividend portfolio, to this portfolio? That ultimately is going to be up to you. The more you can diversify and have those different core strategies in place, the better, I think. But you don't need all of them. You can have, a growth portfolio that's dedicated to capital appreciation and stocks, and then you can say, all right, now here's my income portfolio, right? Or the great thing about the covered call portfolio is that remember, you're generating income, but you're also getting capital appreciation on the successful trades as well. So it's not just the premium, it's also that difference between the strike and the stock price that you're getting to keep as well. Okay. So it's important to understand that as you go through. And we'll talk more about it in the boot camp on how to allocate and average your position sizing and all of that.
Well, I just had a chance to kind of look back through the people who have just ordered Jim, so I just wanted to welcome Stan. I believe we got Stan was the first one.
Yeah, great. Welcome,
Stephen,
Stan.
welcome you, Stephen. A couple of Thomases, Thomas P and Thomas R.
Great.
Welcome to both of you. Barbara, Danny, George, Erica. So if I didn't call out your name and you placed an order, just shoot us a note in the chat box. Let us know you joined the boot camp. I know we're pretty pumped about this brand new event, brand new course, and it gets results. So you'll be ready to go with Jim. And so Jim, there's a couple of things that just came in. Glenn says I just signed up.
Welcome, Glenn.
And he says, let's see, there was one I fled. Rangan says, I have an IRA with Fidelity, so I can use it to get started since I also am in Jim's retirement, URS retirement course, or sorry, coaching group every Tuesday. So can he use his IRA with Fidelity?
Yeah, I'm going to say I'm 100% sure that Fidelity will allow you in your IRA to sell covered calls. Now, bear in mind, you may want to give them a quick call to be 100% sure, but I would be really surprised if an IRA from Fidelity did not allow you to sell covered calls. I would be really surprised.
I know with it's actually a 401k, self-managed 401k. You have to like enable option trading. So you might have to do something like that, where you just have to enable it.
Right, exactly. Yeah, there may be a step or two through your broker, but it's funny. Fidelity, I have. If you name a mainstream broker, I have an account there. I don't have money in all of them, but because it's my job to know that Fidelity, unfortunately, is the one mainstream broker that I don't have an account in. But I would be really surprised if they didn't allow it.
All right, so there's a few more. George says I'm in.
Welcome, George.
Haven't yet received my email confirmation. So we're give it some time. Sometimes and also double check your junk, your spam folder to see if it went over there.
Harry says he uses Fidelity, and they do allow it. Thank you, Harry.
All right, Glenn says, what are the times for the boot camp? 4:30 Eastern. So we've done a lot of webinars over the years, and we found that to be the sweet spot for the most people who can attend is that time because it's right after the market closes, and for a lot of people, if they're still working, they can take the training before they head home, or it's just kind of a sweet spot time. It's before dinner where you're not getting tied up with any dinner stuff. It's not too late, not too early, so and it's also good for people in Europe. And sometimes of the year, it's even acceptable for people who are in Australia. So that 4:30 Eastern time has been a sweet spot. We realize not everybody can make it, but there's never going to be a time that we pick where everybody can make it. But that's why we have all the recordings set up. And Glenn says, perfect, 4:30. All right, so let's see. Next up, I think we have time for a couple more. Michael says, I assume that the market timing is an important factor before entering a trade and doing covered calls. Is that true?
Yeah, it is. And I just typed in a quick answer to Michael, but it is definitely true. Remember, I said earlier that the buy right, okay, the buy the stock, sell the covered call simultaneously is a bullish trade. It's bullish in the sense that we're buying a stock. Somebody asked about selling covered calls against stocks you already own. Okay, so if you already own a stock, it's also bullish. However, if you already own the stock and you sell covered calls, there are strategies that allow for defensive measures, or there's reasons to sell covered call against stocks you own as a defensive measure. We're going to focus on the buy right, and market trends and timing will play an important part in that. And that's all part of the process or the technique that we'll teach in the boot camp. But the short answer is yes, it's bullish, and so we would need a bullish bias on the underlying market to place the trade.
All right, Steven says, I just bought the boot camp. I'm in.
Welcome, Stephen.
Sorry, you're probably welcoming him.
I was. That's okay. Yeah. What was it?
You wanted to know if you're going to be talking about leaps.
Stephen, I won't be. Although what the leaps, as many of you may know, is often referred to as the poor man's covered call. It's not part of the boot camp, but just as a quick point, it is a way to generate income, uh, using technically it's a diagonal spread, but the short answer is we won't be talking about that. No.
All right, and I think with that, Jim, I think that we got the answer. George, Jim, this one just snuck in.
Hmm.
Says, are you going to be doing anything, any covered calls on ETFs?
George, the answer is you certainly can. You certainly can do it. Instead of going too deep into all that, you can do them on ETFs.
And two people had asked, and this one just came in from Glenn. Can this be done on stocks you already own?
Yes, Glenn. Again, we're going to focus on the buy right, but as I was saying earlier, you certainly can. You can sell stocks. I'm sorry, sell calls against any stocks that you own all the time. But you have to keep in mind, there's a risk that the stock can be called away from you. Okay, or as long as you're watching the trade, that you will have to go out and buy back that call option. If you don't want to lose your stock, you'll have to buy it back at a higher price. Now you'll lose money on the short call. Of course, that'll be offset by the upward movement of the underlying stock. But uh, really, the short answer is absolutely, especially in markets like we're seeing now, right? We get some red lights in the price column, confirmed down or DEW down comes. We get a little nervous. You sell some out of the money calls against stocks that you already own. You're lowering your cost basis, you're generating some income, and you always have the ability to buy them back if you don't want to lose the stock. The versatility, flexibility of options is endless. And just with covered calls alone, it's endless. But again, our objective is to grow your net worth selling covered calls.
All right, and with that, I think we're going to start to wrap things up. We will just do a quick reminder here before I pass it over to Jim to officially wrap up. The 395 is good while we are live for the next minute or so, and then it'll go to 495, and it'll stay at 495 for a few days until Monday, and then we close registration and basically can't let anybody else in because live sessions start the very next day. Right, so you only have a few days to decide to get in, and we look forward to having you in the boot camp. We are excited. We spent a lot of time putting this together for you to get you ready to do the covered call. So what I'm going to do is I'm going to pass it over to Jim, and I'm going to mute my microphone so he can do his
Thanks, Brian. Thank you very much. Yeah, and thanks for taking the time and for being here. We'd love to see you in the boot camp. As Brian said, we've put a lot of time and effort into building this system for you because we do believe in the power of covered calls, and we would love to have you on board. And if I can speak plainly, listen, it's risk free. Take the course. If you don't like it, if you can't do it or don't want to do it, we'll give you your money back. So we'd love to see you there. Take advantage of it. I know a couple of folks, if you have any issues signing in, um, Brian, I believe, just put again in the chat box. Please call our product support. You're still going to get the 395 if you're in the queue or whatever. You'll get the 395 price. Just call our team if you've had any trouble with your order. Okay. So even if it lags on a bit, okay, you, we're if I step out on a limb here. If you're here at this webcast and you're trying to sign in now and having an issue, I guarantee you'll get the 395. Okay. All right. With that, thanks once again for taking the time. For everyone who's in, I greatly look forward to seeing you at the boot camp. Think about it. You have till Monday if you haven't signed up already. On behalf of Brian and John, we'll see you soon. Thanks, everyone.